Hi everyone, it's Melissa and Stephen Woods. Today we're going to be talking about solo 401ks and IRAs as a self-employed influencer. Influencer finance, especially during tax time, can be so complicated and confusing. Even if you are hiring out your taxes to an accountant, this information is very important for you to understand as a business owner.
So I want to talk today about IRAs and the solo 401k. And let's start with an IRA. An IRA is something that everybody who makes income has the ability to open. Okay, and there are two types of IRAs. There's a traditional IRA and a Roth IRA. And for all retirement accounts, pretty much, you will either be able to elect traditional contributions or Roth contributions. And I want to go into the difference between the two of those, okay? So let's say that you have a gross income of $100,000 a year, okay? If you make a contribution to a traditional IRA or a traditional retirement account, that will lower your income for tax purposes by the amount that you contribute, up to the maximum that you're allowed to contribute for that account. So let's say that you contribute $5,000 to a traditional IRA. That means that instead of your income being $100,000, now your adjusted gross income, because we're making an adjustment, is $95,000. If instead you decide to put that money into a Roth IRA or a Roth account, your income stays at $100,000 and you put $5,000 of after-tax money, so money that you're going to pay taxes on right now, into that account. Okay? Now, when both of the accounts make money, as you have that money invested, that money grows tax-free. You don't have to report what has been gained or dividends you've earned or interest you've earned each year. But then when you take the money out of a traditional or Roth IRA in retirement, those accounts are treated differently. Mm-hmm. And the difference is, in a traditional account, when you take that money out, at that time, that money becomes income. So let's say that you save $100,000 in an IRA. If you decide to take $40,000 out one year to cover expenses in retirement, that year you would have a $40,000 income because of the money that you took out from that traditional IRA. In a Roth IRA, that money comes out tax-free. So if you have $100,000 in a Roth IRA and you take $40,000 out, your income that year is still zero.
So how this translates, and correct me if I'm wrong, but how it translates is it depends on if you think your tax bracket is going to be higher now versus when you're retired, which IRA account you want to invest in, right? So if you put it in your traditional IRA, it's saying that you think you're going to be in a lower tax bracket when you're retired because you'll be paying less taxes on that income then than you are now. If you put it in a Roth IRA, it means I want to pay the tax percentage on this money right now because I think I'm going to be in a higher tax bracket when I'm retired.
Yep, that's right. And so let's use a crazy example first, right? Let's pretend that income tax rates were 90% right now. And in retirement, you knew that they would be 10%, okay? Obviously, in that situation, right, where you're making $100,000 of gross income, the tax rate's 90%, so you're going to pay $90,000 of taxes in. If you can go put that money into a traditional account now and reduce your income, when only pay 10% taxes on it later, that would obviously be better. Mm-hmm. And the vice versa is true. If your tax rate is 10% now, but it's going to be 90% later, you should obviously put that money into a Roth account right now because you're going to pay so little taxes now versus later.
That's an extreme example.
That's an extreme example, but I like to use the extremes because it really illustrates the point. It makes the math a lot easier.
Yeah.
Our tax law is not that straightforward, and it's not well determined. If you look at tax rates in the past, we have had an income tax bracket as high as 90%. But right now, we're also in a historically pretty low tax environment in terms of income taxes. Mm-hmm. And so, do we really know what federal income tax brackets are going to be in 20, 30, 40 years? No. we really can only look at history and then make an educated guess as to where we think we're going to be in those 20, 30, or 40 years. So why would you want to use IRAs or a solo 401k to change your income? The answer, if you know tax law, is pretty straightforward. There are certain tax credits or deductions that you can only take if your income is a certain amount. Mm-hmm. And I really like to use one called the Saver's Tax Credit as an example. It is meant to be a lower income tax credit to incentivize people to save for retirement. For that Saver's Tax Credit, if you put $2,000 into an IRA, you can get up to a $1,000 refundable tax credit. However, that tax credit has cliffs of income where you either can get that full amount, that $1,000 if you put $2,000 in, or if you make $1 over a certain amount, you only get $400 instead of that $1,000. Or if you make $1 over another certain amount, you only get $200 instead of $1,000. And so in that situation, maybe putting an extra $100 into an IRA or solo 401k would get you underneath that cliff and net you an extra $600 or $200.
So let's talk about solo 401ks, which is a really popular thing to open if you are self-employed.
Yeah, and so to open a solo 401k, you need to be operating a business either by yourself or with your spouse. And that can be in an S corp, that can be in an LLC, or that can be as a sole proprietorship. You can open the account whether your business is structured as any of them. You just can't have W-2 employees besides yourself and your spouse. Mm-hmm. And that solo 401k is a retirement vehicle that you can use to contribute either traditionally or with Roth money. So let's talk about some rules with solo 401ks, and let's start with contributions. There are two types of contributions that you can make to a solo 401k. The first type is an employee contribution, and that contribution works just like your 401k that you would have at a regular W-2 job. So you have a maximum amount that you can contribute to the 401k as an employee, and that contribution is shared across any 401k accounts you may have for that entire year. So let's say that you're an influencer who makes $40,000 a year, but you also have a W-2 job making $100,000 a year. You don't get two different 401k limits for contributing to your 401k. Mm-hmm. So in other words, you can't contribute the max to your W-2 job solo 401k and the max to your solo 401k. You have to share, the max is one amount and it is shared between all accounts.
Aw, shucks.
Yes. Those contribution limits change each year, and for 2024, the contribution limit is $23,000. Mm-hmm. If you're age 50 or over, you also can do a catch-up contribution, which is a limit on top of that $23,000 of $7,500 in 2024. And again, those limits change each year, so for 2025, those limits may go up. You should check what those limits are for your particular situation. The second type of contribution is an employer contribution, and that is a separate limit from your employee contribution to a solo 401k.
A lot of employers do a 401k matching where, like, if you put in a certain percentage, they'll match it up to 1, 2, 3%. And so it's crazy that so many people don't look into that or don't set aside money to invest in their 401k retirement accounts, because it's just free money that they're not taking advantage of from their employer, especially since they have separate limits. So it's something that you definitely want to look into if you're still holding down a day job.
Yes, and as it relates to solo 401ks, that employer contribution is an amount that you choose to contribute to that account. So obviously you are your own employer. Mm-hmm. You get to choose how much you match or put in. And that limit is substantially higher than the individual limit in a solo 401k contribution. That is 25% of your company's income up to a total maximum contribution between your individual contribution and your employer contribution of $69,000. So we take that $23,000 and subtract $69,000. We get a total of $46,000 that may be contributed from the employer contribution. Now the catch there is you can only contribute up to 25% of what your company's income is. And really what that income number is in terms of your business is the profit from your business, right? If you have a revenue of $100,000, but you have expenses of $50,000, your profit in the business is $50,000. That is the amount that I'm talking about that you can take 25% of and contribute to a solo 401k as an employer contribution. So let's use that example. Okay, you have $100,000 of revenue, $50,000 of expenses, therefore your profit is $50,000. You can make an employee contribution of, let's say, $10,000 to a solo 401k, and you can make up to, in the case of a $50,000 gross profit, you can make up to a $12,500 employer contribution. Now, how are those treated differently at the time of retirement? They're not. It's just to determine how much money you can contribute to that solo 401k in a given year. Now, one other really important distinction to make, you can contribute employee contributions to a Roth solo 401k. So in other words, an after-tax solo 401k. So in that example where you make $50,000, you can contribute up to $23,000 into a Roth solo 401k, a Roth designated solo 401k for that employee portion. Any employer portion must be pre-tax or traditional. Okay? So if you contribute $12,500, the max employer contribution, that would reduce your income, your adjusted gross income, from $50,000 to $37,500. And then if you made that further $23,000 solo 401k contribution Roth, that would not change your income. You're still going to pay taxes, income taxes, on that extra $23,000 because you've designated as Roth. So that's a nice way where you can choose which bucket to contribute to, but know that the employer contribution is traditional.
Yeah, my eyes just glazed over for a little bit there as all the numbers came out of your mouth. He is such a numbers guy and I love him for it. But I want to just give a synopsis of what you explained. Basically, both with IRAs and 401ks, there are the traditional version and the Roth version, and the difference between them is when you are paying taxes on them, either in retirement or currently. Understanding these different tax saving vehicles is so important so that you can adjust your gross income to be the optimal amount this tax year. Another tax savings vehicle that I know we've implemented in the past is an HSA. So are we going to talk about that as well in this video?
Yeah, an HSA or a health savings account is another really powerful tool that you can use to minimize taxes and maximize dollars toward health expenses. It is a whole nother topic in and of itself, and something that we will be talking about.
Okay, so look for that in a coming video. Be sure to subscribe or follow along our Influencer Finance channel so that you don't miss it. And I wanted to just say a disclaimer as you've watched this and we've shared all this valuable information, that Stephen nor I are tax professionals, and you should always consult your accountant or do your own research if you feel comfortable to be sure that you are following tax law where you live. Be sure to comment below on this video if you learned anything valuable. I hope that you did, and we'll see you again next time. Bye-bye.